Hello viewers, welcome to my YouTube channel. In today's video, we are going to talk about SMC trading strategy using the market structure, that is supply and demand. What's SMC is smart money concepts. The smart money concept just is referred to using your little money as a retailer, yeah, as a small trader to trade like the banks, trade like the financial institutions, because the banks, the financial institutions and the big boys, they are all referred to as smart money. Then when you can spot out their price or the blocks or the price at which they place their orders and you trade with them, that is when you are doing, then that's when we have that SMC. It usually gives a low risk setup. You can see a setup of 10 pips stop loss, 12 pips stop loss. If you have been following my signals when I drop in the group link is in the description below. My stop loss pips, it doesn't exceed 20 pips, max 20 pips. So I use FMC. Now I'm going to teach you how to understand this SMC, supply and demand basically. Now, what is supply? Supply refers to the amount of assets available, while demand is the quantity of an asset people are willing to buy. Yeah. Supply and demand cannot be denied in our daily day-to-day activities. Even in our normal markets, there is supply and there is demand working on keeping everything in equilibrium. Yeah. And there is this rule or this law that has been following supply and demand for a long. If you are good in economics, you know that when the supply of an asset increases, its price decreases. Also, when the demand of an asset increases, its price increases. So and in trading, supply can be referred to as bearish order block, while demand can be referred as bullish order block. Different traders have their own different terminologies. Okay, me, I prefer calling it supply zone or demand zone. Some will call it order blocks. So when you hear order blocks and you hear supply zone, don't be confused. Just that you have to specify which of the order block. Is it a bearish order block or a bullish order block? A bearish order block is a supply zone. You expect a sell there, and a bullish order block is a demand zone which you expect a buying pressure. You can simply put that supply is a selling pressure, is a zone. Supply zone is a zone where you expect a selling pressure. Then where demand zone is a zone where you expect a buying pressure. Okay, we have two types of supply and demand. The first one is the reversal pattern, and the second one is the continuation pattern. In the reversal pattern, we have what we call the gap and valley. Gap for the supply zone, then the valley is for the demand zone. The demand reversal. Let me repeat. Gap is for the supply reversal pattern, then the valley is for the demand reversal pattern. This is how it looks like. A rally to the upside, a continuation, like a consolidation, call it the base, a little consolidation, then a breakout to the downside, telling you that this market is no longer an uptrend, that has reversed from being an uptrend to a downtrend, that is drop. So you can name it rally, base, drop. I repeat, the rally is an uptrend to the upside. The original trend is an uptrend. It's going up. Then a little consolidation in this box is the base. Then the drop now is the reversal to the downside. When you see this kind of pattern, you do what? You wait. This will be your, at the base will be your entry. Here will be your entry, and above it will be your stop loss, because definitely price will come back, will surely retest this base and continue going down. Then for the valley, the price was in a downtrend, that the drop, then a base, the little consolidation, and a breakout to the upside, that is rally. That we call it drop base rally, telling you that these markets have reversed from downtrend to an uptrend. Then we have the continuation pattern of supply and demand. A drop base drop is a continuation pattern for a a downtrend. As you can see, the market has been on a downtrend. Then a little consolidation, that's the base, and then a continuation to the downside, then a drop. When you see this kind of pattern, it clearly tells you that whenever the market comes to this base, it will still respect the pattern, showing that it's still a downtrend. It should respect it down, start going what? Downwards. There are not going to be a reversal, telling you that this market is still going down. Now, for an uptrend, we have rally base rally. That is a continuation pattern for a demand. Now, the market is on an uptrend from a demand. Now, from a demand zone, it moved to an uptrend. Now, had a little consolidation, that's the base, and then broke out to the upside, the rally. This telling you that the market still remains an uptrend. Whenever the market should retest back to this base, it's still going to continue to an uptrend. Okay, now I'm going to show you the types of supply and demand zones that we have talked about. I'm going to show you those zones on the real charts. Now, first, we know that we have two types of supply and demand. We have the reversal pattern and we have the continuation pattern. We said that the reversal patterns are those patterns, kinds of supply and demand that you're going to see, and you now know that the market's about changing from a downtrend to an uptrend, or from an uptrend to a downtrend. And we also say that continuation patterns are those kind of patterns, are those kinds of supply and demand that you're going to see that tells you that the market is still going to that direction. Even if it's a downtrend, it's still continuing being a downtrend. It's going on a downtrend, it's still continuing being a downtrend. So let's go to the chart. Now, here we have a drop base rally, telling you that this is a valley. Valley, as if you can remember, is the demand zone for reversal. It's reversing from being a downtrend to an uptrend. Let me show you. The market has been dropping from here, from this zone, from this point to this point. Then a little consolidation in this zone. If in this box, there was a little consolidation in this box. Let me open it a bit so I can see what I'm saying. There was a little consolidation in this box here, little correction. Then the market broke out. That's the base. Then the market broke out. So if you see this kind of, and look at it, it's in a V shape. When you see this kind of thing in market, know that the market is reversing from being a downtrend to an uptrend. Now the market will come back to retest that base and then still spike up. That is for drop base rally, or we call it the valley. Now the next one, we have the gap. That's for supply. That is, the market is changing from being an uptrend to a downtrend. That is the valley. That is the rally base drop. Look at it now. The market was in an uptrend. Then there was a little correction or little consolidation inside this box in the 4 hours time frame. If you refine it down to your higher time frame, you will see there are a lot of candles here that is consolidation, and the market had a big time. Like, the market spent a lot of time inside this box. That's the consolidation. I can call it the base of this zone. Then the market now broke out of that consolidation, giving us a drop. That is to say, this is a rally based drop, and it's called the gap. And whenever you see something like this, you mark it out. But definitely, when market comes around that area, there will be a reaction to the downside. So these two are for the reversal patterns of supply and demand. Now let me show you the continuation patterns for supply and demand. The first one I'm going to show you is the drop base drop. Remember that drop base drop is a continuation pattern that tells you that this market is still going on a downtrend, and it's associated with the supply zone. Now, this market was in a downtrend here. There was a drop here, then a base and a drop. This shows that whenever the market comes back to this zone, to this base, just take note of the base. Whenever the market comes to the base, there must be a direction to the type of supply or demand that was formed there. Now this is a drop based drop. This is a continuation pattern to the downside. So whenever the market comes to this zone, there will be a continuation to the downside. Now we have the continuation pattern for the upside, which we call the rally based rally. Now the market was in an uptrend from here going up. There was a little correction and then a push up to the upside. Then we can now say that this market is now officially going up, is an uptrend. What do? You wait for the market to come down to the base and then you take a buy trade. You don't trade against the trend. The pattern has showed you that this trend is in an uptrend, so you don't go and sell from there. What do? You wait for the market to retest that pattern and then you do what? You continue with the trend of the market. Now I'm going to tell you criteria for knowing a valid zone. The criteria for choosing a valid zone. Not all zones, not all demand and supply. It's true that you have known the types of supply and demand, but not all of them are tradable. Not all of them I will advise you to trade, because there are some things that you need to put to check before you can say, okay, this is a valid supply and this is a valid demand zone. Number one is that a valid supply zone or a demand zone, whatever type it is, must lead to a break of structure. In our previous video, we talked about a break of structures and change of characters of a market structure. If you haven't watched the video and if you are still finding it difficult to understand it, kindly go to the previous video I uploaded. I did two videos on market structures, market structures volume 1 and market structures volume 2. Is on my video in this YouTube channel. When you subscribe, you go to the videos, you will see it there. Now I said number one, the zone must do what? The zone must lead to a break of a market structure. Now we see that this market was going in a uptrend from here. Let's just say from here now. Market was going lower, higher high, higher low, higher high, down, higher low, fine. Now the market broke this level, causing a break of structure here. This zone break this structure. That's number one. Now let's say, okay, fine. This demand now, or this supply, sorry, this kind of supply is a drop-based drop supply. Then it caused a break of structure here. Now, the second thing you need to look at is that it must have an imbalance. What is an imbalance? An imbalance are those big, long, big momentum candles that need to be filled up, because market moves in circles to do what? To be in an equilibrium. What do I mean to be in an equilibrium? To fill the imbalance and to create more imbalance. Now, when this market dropped from here, like broke out from this base, there was this long candle formed. Let me zoom the screen so I can see it very well. There was this long candle formed. Then this long candle is separating this candle to this candle. This kind of candle is called the imbalance. And whenever you see a zone that has this kind of long candles, either short or long, but the strongest is the longer the candle of the imbalance, the stronger the zone. So if the candle is very long like this, it's very, very, very nice. That's the most, like, a beautiful zone to trade from. So these two things are now on check. This zone has an imbalance. This zone, this supply zone, has an imbalance, and it led to what? A break of a market structure. So what do? You mark it out and wait for a market to retrace back to it, and then you take your sell trade. Okay, let's move forward and see that the market eventually came back to that zone and did what? I started selling back. The market came down there. We had a change of character at this point, because here has been an uptrend. Then this is the last low. This zone took out this low. Then the market reacted from this supply zone, this here, then continued selling down. So we are seeing that this zone is very strong. One, it has an imbalance. Two, it contributes to a what? A break of structure. So it's tradable. You can trade from it. So if supposing you find a zone that is not that is not that does not have an imbalance, or that does not contribute to a break of structure, I only advise you to stay away from such trade because it's weak. That zone can be weak. Market can just come with just one candle and you just break through it. Okay, let me show you a perfect example of what I'm saying. Okay, look at this guy now. This man over here. Yes, we can agree that this is a demand zone. Why? It broke this level, this break of structure. There was a break of structure here, but there is no imbalance here. There's just a little space. And look at what happened. The market just came and broke it down with this just the one candle. There is no imbalance. So look out for zones that caused break of structures or change of characters, and look out for zones that had what? Imbalance. Okay guys, thank you for watching this video. If you like this video, kindly subscribe, click on the like button, and if you have any questions based on what we have discussed, or based on what I've taught to you, and we are having this kind of confusion about how to identify a valid zone, I dropped my handles on the description of this video. Kindly check out the description. You'll see my handles, my Instagram handles. I will reply, or you can drop your questions on the comment section. I will reply you ASAP. Thanks for watching. See you guys in our next video. Thanks.